Banks play a central role in the global financial system by acting as intermediaries between savers and borrowers. They accept deposits, provide loans, facilitate payments, and support economic growth through credit creation. Commercial banks primarily focus on deposit-taking and lending activities, while investment banks assist corporations and governments in raising capital through securities issuance and advisory services. Modern banking institutions may also provide securities trading, wealth management, and derivative services. Because banks are highly interconnected with households, businesses, and financial markets, their stability is critical to the functioning of the economy. The program emphasizes understanding how banks operate and how their activities expose them to various forms of financial risk. Banks face several major risks that can threaten profitability and solvency if not properly managed. Credit risk arises when borrowers or counterparties fail to meet their obligations, causing losses on loans and derivative contracts. Market risk results from adverse changes in interest rates, exchange rates, equity prices, or commodity prices affecting the value of trading assets. Operational risk stems from failures in internal controls, technology systems, human error, fraud, cyberattacks, or external disruptions. Banks also face liquidity risk when they cannot obtain sufficient funding to meet short-term obligations. Effective risk management frameworks are therefore essential to ensure that banks maintain adequate capital and liquidity buffers to withstand financial stress while continuing to serve customers and support economic activity. Capital adequacy is a fundamental concept in banking regulation because capital protects banks against unexpected losses and reduces the likelihood of failure. Regulatory capital refers to the minimum capital banks are required to maintain under supervisory rules, while economic capital reflects a bank's internal estimate of the amount needed to cover risks based on its own models. Basel Committee regulations were developed to create consistent international standards for bank capital requirements. Initially focused on credit risk, Basel standards later expanded to include market and operational risks. Following the global financial crisis of 2007 to 2009, regulators strengthened liquidity requirements through the Liquidity Coverage Ratio, LCR, and Net Stable Funding Ratio, NSFR, recognizing that liquidity shortages can trigger systemic instability even when capital levels appear sufficient. Deposit insurance systems are designed to increase public confidence in banks and reduce the risk of bank runs. Under these systems, deposits are guaranteed up to specified limits if a bank fails. Although deposit insurance promotes financial stability, it also creates moral hazard because depositors may pay less attention to a bank's financial condition once their deposits are protected. This reduced market discipline can encourage banks to take greater risks by offering higher interest rates and making riskier loans. Regulators attempt to mitigate moral hazard by charging risk-based insurance premiums, requiring stronger capital standards, and imposing supervisory oversight. The program highlights how balancing financial stability with prudent risk-taking is one of the central challenges of modern banking regulation. Modern banking models have evolved significantly with the growth of securitization and integrated financial services. In the originate-to-distribute model, banks originate loans and then sell them to investors or government-sponsored entities, freeing capital for additional lending and increasing market liquidity. However, this model contributed to weaker lending standards before the 2007 to 2009 financial crisis. Banks also separate activities into banking books and trading books for regulatory purposes. The banking book contains assets intended to be held to maturity, while the trading book contains instruments actively traded and marked to market daily. Additionally, conflicts of interest may arise when banks combine commercial banking, investment banking, and securities services. Regulators address these concerns through internal controls known as Chinese walls, which restrict information sharing between departments.